Rising uncertainty and a data blackout. Is the Fed losing control of the narrative? Fed Governor Barr this week urged caution on more interest rate cuts, warning that tariffs could drive inflation higher. Meanwhile, New York Fed President Williams is backing more cuts, pointing to a weakening jobs market. But with fresh economic data scarce due to the government shutdown and voices at the Fed pulling in different directions, can monetary policy stay on course with this many hands on the wheel? Elliot Hentoff is head of macro policy research at State Street. So Elliot, former Fed President Dudley says when the outlook is this uncertain, acting preemptively can be a big mistake. Has the case for a long easing cycle been overstated?
You've packed a lot into that question because you've already said it's the case for a long easing cycle. I think that one indeed is questionable. We ourselves have not been convinced that this is the beginning of a long easing cycle, but just as a little bit to Dudley's word, a little bit of a few preemptive cuts are warranted. So I think a short easing cycle is very justified. I think a long one is very debatable.
Well, new research from the Dallas Fed said that the slowdown in immigration means that the US doesn't need such robust job gains to keep the unemployment rate stable. So are fears of the labour market overdone?
Once we readjust basically the equilibrium payrolls or job creation that's required to basically keep unemployment steady, it used to be 100,000 was like the magic number that was roughly. It's clearly going to be lower. Now, once you drop below 50,000 in terms of the monthly creation, that means as part of a normal economic expansion, you'll start to see payroll contractions occasionally. But historically, payroll contractions were always a sign of an impending recession. And so we're getting into this zone where we all have to readjust and recalibrate our metrics. And so I think right now the easiest way to describe the U.S. labor market is probably no hiring and no firing. And we tend to believe that actually this is just a temporary phase. We will see a renewed expansion, including positive impulses on employment, but not till next year.
Well, next up, President Trump said the continued shutdown delays could eventually trigger mass layoffs. So is that something that the Fed is factoring into its thinking? President
Trump says a lot of things, and I also usually give it a lot of credence, but I do not think mass layoffs are seriously in the offing. I struggle. I can imagine scenarios where we get a prolonged shutdown, which has not been our base case. I do not imagine scenarios where the government sheds labor in large quantities. I just do not. I think that is just a political posturing, frankly. If it were to happen, though, that would obviously change the outlook. But even then, we're talking about a few 100,000 jobs at worst that would be at risk, and not more than that. But again, I do not expect that to be the case.
Let's turn to the other side of the Fed's mandate now, and a recent paper warns that rising inflation expectations, no longer driven by just food and energy, pose a deeper threat. We did see a similar pattern in the late 70s, so could the Fed be staring down a repeat?
Inflation is not going to return to what we saw the last 2 decades. I think that's obvious. Market pricing reflects that as well. Is it a repeat of the 1970s? I think too soon to tell. But what one thing is clear: inflation levels will balance at a much higher level than we've been used to, at least for the majority of my adult life. Inflation will be higher. Will we have runaway inflation like in the 1970s? I still think, with all the doubts around the Fed governance, I think the Fed reaction function will prevent that type of scenario. But elevated high inflation, kind of in the 3+% range consistently, I think that is simply our reality, but not the runaway inflation we did see in the 1970s.
So finally, Elliot, hedge funds are increasingly betting on a stronger dollar through year end, suggesting that the currency slide from Fed cuts and shutdown jitters may be over. So has the dollar found its floor?
Great question. The short-term gyrations, I'm probably less well positioned to comment on. Longer term, we still expect a weaker dollar. We think both yield and growth differentials over the coming years will be narrower as the AI productivity gains diffuse and spread to other economies, as the growth outlook for Europe improves on the back of Germany's fiscal stimulus and so forth. So overall, we think over the coming years the dollar should be weaker. That does not necessarily mean by year end in 2025.
That was Elliot Hentoff from State Street. Don't forget, you can watch more videos on Reuters.com.